everyone. Thanks for joining me today. I'm gonna do presentation for you on Crescent Point. Doing a little bit due diligence here. Yeah, should be fun. Let's have a couple of people to have them join us here and kind of go from there. Okay, well, thanks for joining me. So let's start with the live here for doing a little bit due diligence for Crescent Point. So I will what I'm gonna do today. I guess I'm gonna cover just relative performance, look at what others are saying about this name, as well as show presentation slides. It's gonna be about an hour, and then some balance sheet and kind of what's being produced, and talk a little bit about the company. So you can see here what I did. I'm comparing Crescent Point to Meg and Baytex just for context. To give you a perspective how on the journey of some of those companies and how far they've become. If we do like a 10-year chart comparison between Crescent Point, Meg, and Baytex, you can see kind of a very volatile journey. But those companies evolved over time and became very different from what we know today. And I think that's kind of the common theme for even Crescent Point as we kind of go forward, because they had significant acquisition here. So if we look historically at like a 10-year, it doesn't even matter. This company is very different. Now, if you look at the 5-year performance here, I mean, yeah, you look at Mag, it's basically like up 3 times, but mainly because of the significant decline it had, where Crescent Point is essentially flat for the 5-year, and Baytex is up about 32%. If we compare on a 3-year relative basis, Baytex is up 12 times, so significant rate from the bottom. And it just kind of speaks to the sensitivity of these companies to oil prices and how far they've become. And Meg is up 7 times, Crescent Point up 6 times. So today we're going to be talking about Crescent Point. But that kind of gives you a perspective. If we look at the 1-year relationship, so essentially Meg is up 30% in 1 year, which is that red line right there. Crescent Point up 8%, where Baytex down 8%. So, and I think what's really important to remember here is that Crescent Point, as we're going to be talking more and more about this name, they had this kind of decline here around February, and the reason for that was I think that because they made this acquisition, right? So or maybe we just saw a decline in oil prices. So I'm not exactly, I don't exactly remember why we had this decline. You can see it's fairly correlative here with the other names, but I think I remember. So Baytex declined before because of the deal, where everything else kind of declined with oil prices. And I think Crescent Point did a deal just recently, and it didn't suffer as much. So it's kind of really important to keep this in context on how those names um, behave relatively to each other. So if we zoom in the 6 months, right now we basically had this acquisition that was announced for Crescent Point. I think um, maybe around March. I think so. You can see they actually recovered fairly well. Basically up 4% on the 6 months, where Meg is up 27% and Batex is down 21%. And I think this context is important because on a relative basis, both companies, Baytex and Crescent Point, did a deal, and so one kind of suffered a little bit more versus the other. So we can speak about this a little bit more as we go forward. Okay, so right now what I'm gonna do, I'm gonna stop sharing the screen. I'm gonna maybe share just what others are saying about Crescent Point, mainly on BN and Bloomberg, and kind of how the street is seeing this name. Maybe just cover some of those comments from commentators, and kind of go from there, sharing the presentation uh, the presentation and the other aspects of basically the balance sheet. So if you were to ask, basically, I think so. John Zechner, he runs I think a fund, and he was in the market call earlier. Not earlier this year, but late last year, so in December 2022. His comments on Crescent Point that this back then the company was up 69%. Since he made it a topic in December, 1 year before that, and he said that this company performed very well, which it clearly did. It was up 69%. And he was saying that high energy prices should continue to hold. So that was his kind of understanding of what's going to be coming up here. New discipline paying off for shareholders, returning capital to shareholders, increasing dividends, paying down debt. And there's significant evidence of that. And we will be talking about how Crescent Point was able to pay down debt. But because of the recent deal, they actually increased the debt, but we will cover that as well. And then share buybacks. He basically said will reward shareholders. So he thinks excess cash flow should be invested in renewables or other growth areas. So that was kind of his comments back in December. Alex Roos was mentioning in February that he said that Crescent Point is a good company at current share price. The share price back then was, I think, roughly the same as today, so 9.90 in Canadian rate. And the energy stocks have stalled at current prices. That are some of his comments. Supply demand situation settling in. SPR purchased by US at 70, good for investors. But again, we've been since then, since February, there was a lot of kind of discussion about whether the SPR is going to be refilled, and we've seen basically the United States government deciding that they're not refilling SPR as of now. So we will see how that can unfold as we go forward. And he basically said that $70 to $80 floor good for business. That was Alex Roos back in February, covering Crescent Point, talking about Crescent Point. His recommendation was back then that it was a buy. Then John Zechner came back end of February, and said that this name should be bought on weakness. He said he's buying hard to resist a stock that's trading at 3.5 times operating cash flow. Soon we will see what that number actually is when they're starting to pay down debt. And again, this was before the deal, right? So these guys didn't know that the deal going to be made, so they made those recommendations. Return cash to shareholders, unwind mistakes of the past decade. Risk is oil price collapse. So that was risk is oil price collapsing. That was kind of the risk to the name. But he's really wasn't worried about that. Despite any slowdown, there's still a lot of supply issues, and that's kind of what we've been seeing on the supply side. Then in late February, Eric Nadal was visited BNN Bloomberg, and his comments were that the inventory is very light, and so the recent deal, and we will see, kind of adds to this inventory. And the better namestone in the energy sector, that's what he said in late February. Current shares are mispriced, but very short-term hold given inventory concerns. Those are our comments. Then in March, technical analyst Keith Richards, he said about Crescent Point that he traded the stock in the past. He said it's a buy. Current trend line suggesting good time to buy. Energy fundamentals are strong. So those were his comments about a month ago. Ross Healy commented on this name. It was his past top pick. He said it's nice in the past year and could get even better. Still bullish on oil and gas. Those were his comments back in early March. Then Eric came back in late March, and he's actually said that this name is a buy. And his explanation to this was that there's concern that the company is inventory light. Duvernay assets better than people believe. Tier 2 economics present a good investment case. There are 13 years of inventory Duvernay assets and pledging 50% of free cash flow returning to shareholders next year. So look for good for long-term investment. So those were the comments that made back in late March. And then there was a technical analyst on BNN last week, I think, and he commented on Crescent Point as well, basically saying this is now hitting resistance at $10. It's range $9 to $10. You can enter, but make it partial position, considering yesterday OPEC oil cuts in Russia pays a nice dividend. So those were some of his comments. And then John Zechner came back to Crescent Point, commenting as his past top pick, and he said, good job concentrating their portfolio. Acquisition looks to the future, more profitable to do acquisition than to drill. And the stock was at roughly $10, which is where it's at today. So I think right now what we can do, I will share another screen which kind of speaks to the balance sheet, and then we can go and look at their presentation. By the way, guys, I'm not a financial advisor. I don't recommend anything. I don't hold this name, even though I think it's a really interesting company. I'm just here to do a little bit due diligence, really share kind of what I'm seeing, what I think is kind of happening here, share it with the community. No conflict of interest here, and please don't follow any recommendations from what you see here. And hopefully this helps you to kind of make your decisions better going forward and kind of add to your additional due diligence that you guys are going to do. But I'm just trying to add value within the community and kind of share the type of things I'm looking at. So right now what I'm going to do, and by the way, I'm streaming live on Twitter right now. I'm streaming live on YouTube. My handle is Razor Oil, as seen below, both on YouTube and Twitter. Okay, so let's share. Yeah, so what I'm going to do now, I'm basically sharing a screen here. This is what I found interesting here. So this will be page, yeah. So what the document I'm looking at right now for Crescent Point Energy is basically their 2022 year-end disclosures. I think it's important kind of to keep it in the context what's been taking place and where we're going to go from here. I made some notes about the pages that I want to discuss today, and hopefully kind of adds value to you to look a little bit further, because obviously we can't cover all of the pages. There's significant amount of material here, and hopefully kind of helps everyone to better understand Crescent Point. So as we look into kind of their production for year end of 2022, and this is now going to change because they made this transformational deal. We're going to be talking more about this. You can see kind of their partitioning in kind of based on what they're actually producing. So you can see here 2021, 2022. We're going to be doing a little bit of a deeper dive into what they're actually producing, but really trying to better understand their supply kind of what product they're selling. Okay, just quickly looking at the comments here, making sure. Everyone's happy on Twitter live and YouTube live. So what you see here right now on this slide, you can see crude oil and condensate in barrels per day. So this will be the kind of the heaviest molecules these guys are producing, and their production is as of end of 2022 was 91,679 barrels per day. So this is kind of the heaviest molecule that they will be producing. NGL stands for natural gas liquids. Those will be kind of the heavier ends of the NGL mixture. And so they will produce about 17,039 barrels per day doing that in end of 2022. And then you can see on the natural gas, they produce just over 141,000 MCF per day. And then you can see basically you kind of add those numbers, and then because it's in barrels per day, and then basically the total number of barrels produced in BOEs, which stands for barrels of oil equivalent, where you end up adding the barrels per day for each of those, and then MCF a day being, there's a 6 kind of multiple to that, and it's being translated into BOEs per day. For many people, this metric is very frustrating, but at least it kind of gives us a relative understanding of the barrels of oil equivalent production year-to-year basis, which is in this case, basically this suggests there is no decline in their overall production, as you can see here. So the natural gas. So what this basically tells us, they produce crude oil and condensate. So the density for something like this could be like, I don't know, like 850 kg per cube. NGL lighter ends maybe like 600 to 800, and natural gas about 500. So there will be like light ends and heavier ends, but that's what they're producing. They're not producing heavy like stuff like bitumen, so they don't do thermal. And soon we will see their assets. The crude oil and liquids partitioning, but in 2022 it was 82% liquids. Back in 2021 it was 86. But this number right now is somewhat irrelevant because they did this transformational deal, and we're going to have to look kind of what that looks now going forward. You can see here in 2022 they have several regions where they operate, right? And you can see the partitioning where the production is actually coming from. So production by area, they produce in Saskatchewan. So they have about 69,000 barrels per day as of end of 2022. Alberta about just over 44,000 barrels a day, and North Dakota 18. So I think it kind of gives you a perspective where they stand when it comes to kind of regional production. So right now what I'm going to do, I'm going to go to page 20. And there's a lot of like really good information here, but I can't cover all of it because the time is fairly limited, and really try to do kind of a deeper dive into some of the economics as reported in 2022, and showcase some sensitivities to how this company basically evolved through the acquisition and what they're basically telling us. So end of 2022, they produced over 132,000 BOEs per day. You can see kind of what happened on the overall decline rate. So the wells, they will have a decline, but in overall, because they're drilling new wells and able to kind of stage them, there's essentially no decline in the asset, right? So, and by the way, Crescent Point is kind of, there's lots of pockets in different regions, and they operate across many areas, which doesn't make that story very easy to explain. But you can see in overall, if you look at the numbers, 2022 they produced 132.2 thousand, 132.6, and that was a big uplift from 2020, where they produced 121 in a very difficult time of a downturn. But that kind of gives you an understanding that as oil prices were going higher, that's the relative increase in production that was taking place. You can also see like the sensitivity on net income and loss on according to the oil prices, right? So you can see here basically 1.48 billion dollars in net income in 2022. It was much higher in 2021, but look at the significant losses they took on the net income in 2020 because of the reduced oil prices. So I think it's really important to understand that Crescent Point gives you kind of the torque associated with elevated oil prices. But if oil prices are going down, obviously there's a significant amount of suffering that's taking place here. Cash flow from operating activities, again, looking like really good in 2022, just close to $2.2 billion. A lot of that was to deal with debt levels, but that debt level is currently is irrelevant, as I mentioned, because they did that deal. So we're gonna have to review what was actually done since then. But you can see like cash flow was very small back in 2020, almost $1.5 billion in 2021, and boom, you have almost $2.2 billion from cash flow from operating activities in 2022. And you can also see the adjusted fund flow, right? So from operations, which is kind of a function of the cash flow, very very similar numbers, but you can kind of understand the torque associated with that. Now, what's really interesting is that the question is, what did they do with that money that they were able to, basically to generate because of the elevated oil prices? And look at the net debt value. So right now, the net debt I think is closer to $3 billion. But if you see here, 2020 was very challenging, and that's why I showed the relative performance over 3 years, because they really like the stock really collapsed and now kind of recovered to $10. But you can see how they were able to pay down debt, going from $2.1 billion to $2 billion, and then this is significant drop here in debt, which speaks to the torque they're able to generate when it comes to their ability to kind of generate free cash associated with their operations. So they're basically going from $2 billion net debt to like 1.1, but now back to 3 because of the acquisition. So hopefully, kind of gives you a little bit of an insight to how to think about this. Now let's review the quarterly activities. So summary of the quarterly results. Again, you can see 134,000 barrels BOEs per day, because you have the natural gas MCF per day production. You can see how the partitioning kind of takes place. So 136, 130, 144, 153. So it was kind of getting a little bit gassier over time for Crescent Point. You can see, for example, for the numbers, you really want to have a little bit more kind of torque, crude oil and condensates, right? Those trade at close to WTI level. So you kind of see a small decline. And maybe that tells you the story that maybe that's why they made this acquisition, right? And they were maybe wanted to get a little bit more oily. NGL, yeah, one could argue it increased, right? So going from 17.2 thousand barrels per day to 17.7. But in overall, you can see there is production growth, which is great. There was this decline, so 148,000 in Q2. So big production uplift from 120, and then going to 132 and kind of staying there. And maybe that alludes to the fact to why they made this acquisition. You can see on the quarterly basis now. Let's take a look at the net income loss. So Q4, there's a loss that was reported. There was some income. So this is kind of something to could be interesting to look at why this took place. But then the Q1 was very strong, and as mentioned, they were able to kind of pay down debt. And if we're looking at the debt levels here, they went from 1.7 billion, kind of really doing a good job declining here on debt levels, to 1.4, 1.2, 1.15, and now basically going to back to $3 billion in debt because of the acquisition. Adjusted fund flow from the operation. So we have 534, 599, 557. So very strong numbers. And obviously they declared some dividends here going forward. So and there will be dividends going forward. We can speak to that more when we look at the presentation. But you can see how dividends declared and what they paid per share right here, and even in 2021, right? So that number clearly increased in Q4 2022. So as we can see here, so significant uplift kind of in the dividends paid by Crescent Point. The other thing I think I wanted to share from this presentation, that I really enjoyed that one slide they have, and I think that our community will really benefit from that. And I'm sure you guys are going to thank me about this going forward, and please do, because I think like this is really gives you a lot of insights to what normally people in oil and gas talking about when it comes to benchmark pricing, right? And I think Crescent Point did an amazing job here, describing essentially what are the relative prices, and I think it's really important before we proceed to their presentation, to look at those. So as you can see, you have benchmark pricing and you have crude oil prices here. So that will be WTI in US per barrel. And so that number in 2022, and mainly because of we had this significant uptake or increase in WTI prices, especially end of February because of the Russia war on Ukraine. And on average, 2022 averaged $94 WTI, so very strong prices. WTI in Canadian dollars was 122.5 dollars per barrel Canadian, and you can see it's a significant increase from $85 in the previous year. Sorry, guys, I'm a little bit still trying to recover, but it was $85 Canadian in the previous year, so it changed 44% for 2022. Yeah, so for WTI crude oil price in US per barrel, it's about 40%. So that's what gave Crescent Point this a lot of torque in their ability to generate the free cash flow and paying down debt significantly. So what you see here, and I think that's what I was talking about, that it's really important to understand because this company deals with many different regions, many different productions, like you saw liquefied natural gas, NGLs, right? So natural gas liquids, you saw condensates, you saw crude oil, you saw natural gas, BOEs per day. They get different prices for those products. And so what they're basically telling us is that, so there's this LSB crude oil, right, which is essentially light sour blend crude oil price. And it basically tells you the relative differential to WTI, right, so in Canadian dollars. So you can really see kind of the discount of that LSB crude oil price. Now you have this FOS, which stands for Fosterton crude oil price, which typically receives a premium to Western Canadian Select price. And you can see that in 2022, that differential was close to $22, and it was about 13 differential to WTI in 2021. And I think that kind of a little speaks to how WCS looks like going forward, because there is this kind of correlation between the two prices. So obviously, I think WCS right now with $15, where you can see that FOS is 22 to roughly 13 in 2021, 69% difference year to year. So which is significant, right? UHC crude oil price, UHC stands for and refers to sweet at Clearbrook crude oil price. So you essentially have a slight premium from UHC to WTI. And C5 plus condensates in Canadian dollars per barrel, very close essentially to WTI, and that's why we looked at basically their oil production and condensate production, because the kind of the pentanes, the hexanes, the trade at roughly WTI prices. And obviously we have natural gas prices, so they told us they're producing natural gas. We have ECO, so obviously there's a definition here. So Crescent Point does a good job defining it for a retail investor that doesn't know what it stands for. ECO stands for Alberta Energy Company Natural Gas Prices. And we have NYMEX, which is the New York Mercantile Exchange natural gas price. And you can see kind of the relative prices for 2022 and 2021. But of course, towards 2023, we see much lower prices. So I think it's really important to be mindful of that. So hopefully this slide kind of helps to better understand other presentations that we're going to be having, because it's not just WTI, it's not just WCS. There's like all those like random differentials to the prices to the different like products and different locations where they're being transported. And obviously West Texas intermediate crude oil price is kind of this benchmark price where you have a differential to all other crude oil and condensate differentials and natural gas differentials, and they all kind of correlate like on the hydrocarbon chain, but there is this kind of like relationship of maybe there is a premium to the product because of what the product is and what how it's being transported, and also there is this kind of relationship between sometimes when you have unique situations, those differentials, just like what we see in FOS, 69% basically differential here in 2022, and obviously that changes in 2023. So I think it was really important to share that and to be mindful of. So obviously, I encourage everyone to take a look at this Crescent Point the 2022 reporting, and they have this management discussion and analysis, the structure of the business. They have a lot of very interesting graphs here on their production, and you can see crude oil and condensates, natural gas production going forward. But obviously, because of the deal now, this changes a little bit. So we're going to have to talk about this as part of their presentation. And you can also see how crude oil and condensate stream exposure is associated with the prices that they provided. So you can see that circle. So 38% is LSB. So and 22% is FOS. So let's go back to the table. LSB trades very close to WTI, but has this slight kind of discount, and FOS trades close to WCS, where C5 condensate exposure is very close to WTI. And let's see what, so that's C5 condensate, right? So now you can see C5 in yellow, so that's 21%. This is not intuitively easy to understand, I think, for a person that's not involved in the sector or doesn't know how it works. But hopefully I was able to give you a little bit of a insight, kind of how Crescent Point is seeing that. At the same time, you can see there's a really good graph here. It shows crude oil and condensate prices, Canadian operations, and then basically they put themselves here and where they are located relatively to WTI. And you can see there's not much difference, well, a little bit of a delta because of all those kind of weighted products that they've been disclosing with natural gas and FOS and LSB and WTI. But you get a good understanding, I think, from what Crescent Point actually gets paid. And again, crude oil prices and condensate prices here. So obviously very close to WTI as discussed. And they do a very good job, kind of have a summary of realized commodity derivative gains and losses. So there's a lot going on here. So hopefully it kind of helps you guys to better understand what's been happening as we move now towards their presentation. So I'll stop sharing right now. So hopefully it looks good at this point, but yeah, hopefully you guys like this presentation. Okay, so let's go straight to the presentation. And the first slide I picked here from what Crescent Point is sharing is actually not the first slide, but I think it's an important one because it does a really good job describing what this company is post-acquisition and what it's all about. So capital market summary and guidance. I will spend a little bit of time on the slide because I think it's really important to understand what's going on here. Okay, so what you see here right now, this company, so Crescent Point CPG, it trades at on the TSX and New York Stock Exchange. Okay, on the TSX is just over $9, maybe as of March 23rd, 2023. Today we're April 9th, as we do this due diligence to understand this company. And I think it trades maybe closer to $10 today, where on the New York Stock Exchange is probably closer to $7. Now look at the shares outstanding, 547 million shares. You can see the relative volume, 14.8 million average trading volume. Dividend yield currently 4.4%, right? So really important to be mindful of the fact that this company pays dividend. Market cap 4.9 billion and net debt 3 billion. So 3 billion, right? So but then one could say, well, but they were paying off debt so nicely. What happened? Well, a deal happened, and I think it's really important we talk about this deal and really trying to explain whether this deal benefits Crescent Point or not. I think personally they did a good job on this deal. So let's take a look. It kind of involves the Smartney assets, and we did a live space on Twitter with Tom McInnes talking in detail about the Crescent Point acquisition. So if you guys want to listen to that on Twitter, my ticker is Razor Oil. I scroll down and you can always listen to that space describing this deal in the detail. But in overall, what you can see here, basically close to $5 billion market cap, $3 billion in debt, so $8 billion enterprise value company, which is transformational for Crescent Point, right? Like, I mean, you go down, you're paying down all this debt, get down to this $1.1, $1.2 billion, and now all of a sudden you add additional like $1.8 billion in that. But it's not as simplistic as I just said, but let's kind of be mindful of that. Okay, so let's look at the guidance. So from what I showed previously on 2022, okay, just I'll take 1 second. I have some comments from, yeah, okay. Yeah, so everything looks good. So the reason why I showed you the balance sheet for 2022 end, because you saw the relative production for condensates, for natural gas liquids, for oil production, and for gas production, right? As we go down kind of on the hydrocarbon chain, you saw heavier molecules, you saw heavier ends on the kind of on the butane propane side, you saw some natural gas, and I think their production was like around that number, like 138,000. I think it was like 132,000, 135,000, something like that. But what they're saying is like, hey, looking forward. So right now, basically, this presentation transitions towards what's coming up here, because we have a good understanding now that Crescent Point is a company that gives you significant torque, whether oil prices are going higher or lower on both sides. Like, so 2020 was a horrible year, right? It was pretty bad. Significant amount of money was lost in 2020 for this company, but they did amazing in 2021, 2022, going into this kind of bullish cycle where oil prices were elevated. And it just gives you kind of a sense of how they were able to deliver their balance sheet by paying down debt and actually even having this dividend, right? I'm not sure exactly like what happened to the shares buybacks. I don't think I looked at that, but again, because of that deal, I think it's important just to kind of say, okay, this is fairly transformational. Let's look forward. And the reason why it's really transformational is because their guidance for 2023 outside of the deal was to produce roughly 140,000 barrels per day. Now, if you take, so I'll take a quick calculator here. So let's say they have $8 billion, well, roughly, right? Not exactly, but I'm adding 5 billion to 3, and I'm dividing this by their production. So 140,000, that's roughly $57,000 per flowing barrel. But now basically, because of the elevated production associated with the deal, and we can take the maybe higher end of 166,000 barrels per day. So we will say this company is $8 billion company, and it produces 166, let's say, 1,000 barrels per day. That's about 48,000 per flowing per barrel. So fairly transformational, good on them, right? But they kind of added this additional enterprise value in a way by being a bigger producer, essentially, right? But let's look kind of what's going to happen going forward. So that deal, because of that kind of addition to debt levels, overall market cap, previous production and current production, you can see now basically that they're essentially, if you take an average 140,000 barrels per day, this is 164 or 163,000 barrels per day. So let's say they added additional 23,000 barrels per day. That's kind of my understanding of what's happening here. Now, previous capital expenditure program, and I think it's really important. So this is key, right? Like, what is Crescent Point paying when it comes to their capital expenditures? And really, it's a function of development capital expenditures, and there is this capital administration, which is roughly $40 million, and it basically kind of stays the same number pre and post. But you can see that essentially add a little bit to their capital expenditure program, probably to give some more money towards the newer development there. So essentially, on the capital expenses, on the capex, you go from like roughly $1 billion to maybe 1.2 billion, 1.3 billion on the capex, right? Other information and guidance, so they have small reclamation activities, so $40 million, capital lease payments, $20 million, annual operating expenses, so dollars per BOE. So thank you, Crescent Point, for doing that. But look, guys, this number is actually, like, if you look holistically, kind of declined here on the revised statement, which maybe suggests lower kind of capex for the newer asset. So that's really good to know, because now, because of my previous slides that I showed from kind of management communicating about 2022 year-end status, you can really see here how much money they're going to be spending on the capex, and you can start kind of adding their capex, opex, all of the activities, and really try to understand their cost of supply or the break-even price. And royalties, obviously, yeah. So I don't think much changed here on the royalties. So 13.7 to 14.2 and 13.2 to 13.7. So, and there is some language here that revised annual average production is composed of 75% oil condensate right here. They say it, and NGL, and 25% natural gas. So that's really kind of cool to see. Return of capital outlook, base dividend, currently base dividend per share, they're paying 10 cents per share. An additional return of capital, they're basically saying the percent of discretionary excess cash flow is 50%. And they're giving you some funds flow sensitivity. So just like what we did with Meg in my previous due diligence video, they're giving you some sensitivity to WTI prices. So they say, hey, when WTI goes up by $1, the funds flow sensitivity is $40 million. So let's say we have this OPEC announcement now on potential cuts that we've had, and overnight the WTI jumped from by $5. Well, that's 40 times 5. That's substantial, right? So that's like additional $200 million in funds flow sensitivity for Crescent Point. So I think it kind of speaks to how important to see this company is also in light of actual like thesis on the oil price, and really kind of to understand this a little better. So as you can see, I'm trying to be very strategic in the way I present this data. What we did initially, I showed you relative performance of Crescent Point relatively to Baytex and Meg, just to really understand kind of like where we came from 10 years ago, 5 years ago, 3 years ago, 1 year, and kind of relative performance. But also remember, those companies, they're not easy to understand. They operate, in different regions. They have very different products like NGLs, condensates, oil, natural gas. They have different percentages associated with this, and then for every region they get paid differently. So hopefully I was able to do a decent job kind of simplifying it for you guys to kind of show you that, hey, there's all these regions, there's price that is being disclosed by Crescent Point. They're telling you exactly how much they produce when it comes to percent. And then there was this amazing chart that told us exactly like what are they actually getting paid and where they're located, where they actually simplified it for us. So this chart, this slide is slide 17 on their on basically their presentation on their website, and this is updated revision to post deal essentially. So you can see prior production, revised production. You can see the current enterprise value here, the dividend they're going to be paying, and some of their sensitivities. So hopefully you guys are pretty happy about that. So right now, let's kind of go and cover some slides. I think we have about 17 minutes here. I'm trying to do like about an hour of that due diligence, like to better understand what's going on and make a decision kind of for myself, whether I want to be invested in this company. And by the way, I'm not a financial advisor. I hope I'm able to add some value for your due diligence. And please don't follow this as a recommendation. I'm trying to be very careful about not recommending anything. So I'm a community member on Twitter, and I'm just trying to do my best. If you guys want to support me, I wrote this book. It's called Apollo Autism. It's on Amazon. It really books that helps kind of some of the things it says here on the front. It says perfect for anybody balancing life, ambition, family, and personal challenges. Alex expertly encapsulates life on the spectrum. So that's from Dallin Laycock, PhD, scientist, author. So and then we have a comment here on the cover of the book. It says cleverly written classic about love and acceptance. This book's helped me better understand my children and myself. And I think it's really important to keep, when you do investing and mental health. I think it's really important. And writing this book and sharing this book with the community, it really helped me personally just become more patient and more kind of like a better rounded human being. So if you guys want to support me, Apollo Autism on Amazon, and this is kind of a little bit more information about me. So yeah, I could share a link, but hopefully you guys are able to support me with this book, and hopefully you enjoy it. Okay, so let's basically look at because all the slides going forward are really about kind of their deal that they made, uh, and let's look at some of their basically comments from management here about the deal and what they're telling us, going forward. And right now we know the numbers. We did a good job kind of looking at the numbers, understanding the relative production, and really looking at what the management is going to be telling us about this deal going forward. So what they say here: significant accretion and exit cash flow generation, enhanced returns of capital-driven financial accretion, improved sustainability, balance sheet financial flexibility. They said that pro forma leverage ratio of 1.3 times adjusted funds flow. Okay, sounds good. And they're really in support of this deal, and it's kind of aligns with their long-term strategy, as mentioned here by the CEO. I think what's really important to mention is that when I started this video doing due diligence, one of the kind of complaints about this company was they don't have long life reserve, and by doing this deal, I think they were able to kind of achieve that. So let's look at the transaction details. So they're acquiring Spartan Delta's oil and liquids rich Montney assets in Alberta. So that was the deal. A consideration of 1.7 billion cash, and transaction expected to close Q2 2023. So right now we're just started Q2 2023. So we're, as of now, this is April and 9th, 2023. So I guess this transaction is going to close this quarter. That's kind of what I assume. It hasn't closed yet, so I think it's also important to be mindful of that. Okay, so asset attributes. What are they saying? 38,000 BOEs per day. Again, BOEs, not barrels. BOEs suggesting there is a lot of gas and kind of higher, lighter ends, I would say. And again, exactly what they're telling us: 55% oil and liquids. So 45% essentially gassy, right? So 38,000 BOEs, and they add to their portfolio about 45% of the light kind of gassier ends. They also added 600 net Montney locations or 20 years of premium inventory. So this is key. The 20 years, this is something that's been kind of used a little bit against them with kind of the Wall Street or Bay Street guys. But hey, they added some inventory here, so good on them. So 235,000 net acres of contiguous Montney land, Gold Creek and Carr area. Accretive metrics: increase excess cash flow per share, so 20%. And so that's kind of why they executed on this deal. 3.2 to 3.4 times net operating income at $70 to $75 WTI, and 2P recycle ratio of 2.2 2.3 including FTC. So 70 to 75, right? And so they basically share here. There's some disclosures here, but we're kind of running out of time. The FDC stands for Future Development Capital, just for those of you who don't know. But essentially, this is an attempt to increase their acreage, to increase the oil production and gas production rate. So basically, what they did through that deal, and they're basically telling us here, hey, this is how the economic growth strategy here. We're increasing our inventories here, over 20 years of premium inventory in the Montney, 55% oil and liquids, 45% gas. So that's what it is. And then they basically talk about high quality assets in volatile oil fairway adjacent to Kaybob Duvernay. So that's really interesting for me personally. And they give us some kind of operating conditions here for what they're doing. So if you know the map of Alberta, you can kind of see the angle here. You can see where Alberta Montney is located and the Kaybob Duvernay region. And they basically talk about volatile oil. They have liquids rich in yellow, and in red, the lean gas. So you can see how those geologies, they basically kind of change not only in the composition of the production, but also geographically. Like the geology changes significantly as the hydrocarbons were kind of migrating and moving and developing those different kind of formations that we're seeing today after millions and millions of years of movement and migration and high pressures. And you can see kind of that area here that they specify here. So volatile oils, so those are oils, but they will have some bubbles, I guess, in them. So they will be like the hexanes, the pentanes, liquids reach, exactly like butanes, pentanes, hexanes, kind of going into the heavier molecule, and lean gas, essentially ethanes, methanes, as you go down from the hydrocarbon chain. Key attributes of high quality resource plays. Here they talk a little bit about the. Maybe I'll spend a little bit of time because it's something that I'm very passionate about. Thickness net pay in meters. So the Crescent Point Cape of Duvernay, it's about 30 to 60 meters in net pay in the thickness. For Crescent Point, Alberta Montney, I think that's the asset they just kind of acquired. 70 single bench, 240 multiple benches. And this is really the kind of the tuxedo cake that we talked a lot about, where you have different layers all over the place, and they basically can lead different kind of multilots and different wells to extract different kind of hydrocarbons from those regions. Pressure MPa. So pressure MPa 45 to 75 MPa. That's very deep underground, where the Alberta Montney is 20 to 25 MPa. Just give you like a reference of what this means. Right now in the room where you sit, it's about 100 kPa pressure. The pressure in your tire is about 300 kPa. This pressure we're talking about here is 45,000 kPa. That's kind of what this means. This is very deep, kind of underground. So, and I assume, so driver for productivity and ultimate recovery factor. I assume there's this kind of geological formation there where this is the pressure at which they operate. But very, very high pressure that they have in the Cape of Duvernay and Alberta Montney. I'm not suggesting this is the current pressure that there is, but they're basically saying, hey, this is kind of the pressure for a driver for productivity and ultimate recovery factor at which I assume they operate. So highly, fairly high pressure K-Bob Duvernay, sorry. Not kebabs, no, but the K-Bob and Alberta Montney 20 to 25 MPa. Maturity, volatile oil, liquids rich and lean gas, volatile oil in the Montney. Indication of various hydrocarbons that are in place. And that's kind of what I was talking about, because essentially like this is a hydrocarbon chain. You have light ends, you have heavy ends, and that's kind of where they operate. The depth in meters, and that's very supportive of the pressure that they indicated, because look here, guys, depth in meters. So you have 3,000 meters to 3,400 meters. So that's 3 kilometers underground, right? This is very deep, where this is 2,000, and that speaks to the operating pressure of 20 MPa. This is 45 MPa. So the reason why they operate at higher pressure, because the geology is at higher pressure there, and so I assume they land those like multilots and extract the hydrocarbons, but they have to operate at that higher pressure, right? So just imagine the pressure on the pipes and the carbon steel and stuff. So okay, so we have about 7 minutes here. So obviously there's so much to talk about, but we can't cover all of it. To talk about the strategic acquisition that aligns with long-term strategy, highly accretive to asset portfolio and financial results. You can see in the map, you can start seeing basically the wells that are located at Gold Creek East, Gold Creek West, the Montney, and the Simonte, I guess, Duvernay. And you can see kind of what the operation looks like. They're land in yellow, and the wells they're landing. So there's lots of opportunity here to land more wells, I guess, in the future development. And that comes with basically them saying, hey, like, we have more reserves now going forward. And again, this is exactly what they're saying. Deep inventory over 20 years, 600 net Montney net Montney locations, and which only 25% are currently booked. And you can see why they say that, because there's lots of land but no wells. Highly economic type wells expected to pay out in approximately 10 months from initial on-stream date. So that's really interesting to see. Opportunity to apply technical expertise, close proximity to Crescent Point K-Bob Duvernay asset with similar characteristics. So they basically say, hey, we're technical experts in this. We know how to develop this asset. And disciplined plan to maximize excess cash flow. So now we can actually see the actual economic. When you see the number EUR, the acronym here, EUR stands for estimated ultimate recoveries. So this is an important kind of thing to learn, I guess. Estimated ultimate recoveries. So when you see basically 710 MBOE here and the percent of the liquids, That's kind of what they're talking about. But you can see, I think what's really powerful here for me, it's really to see the cost per well for each one of those regions that you can see on the map. So on the map, you can see kind of CAR in the south end here, where they basically tell us this is volatile oil in green, liquids rich, and lean gas. And CAR is at the bottom here. Gold Creek East is kind of to that northwest corner, and Gold Creek West is kind of to the, northeast and northwest corners. So location 1 and 3 is kind of on the east side. Locations 2, 4, 5 on the west side. And they basically tell us, hey, we're going to be paying $9 million to drill a well on the west side, and we're going to pay $9.5 million to drill a well on the east side, and we're going to be paying $10.5 million to drill a well in CAR. But then on the NPV 10, so net present value of 10%, so if you borrow 10%, and how much, like, what's your actual net present value after you spend that capital on those wells? It basically tells you $9 million, 13, and 18. So then, yeah, sure, you spend a little bit more, you pay more, $1 million more for CAR, but look at the economics, right? It gives you like that extra NPV. And in the payouts, and I think there's this correlation between the type curves. So basically, like the production rates and how fast you're able to pay it out. It's about 10 to 8 months here. So on the west side, basically, it's about 10 months, which is great. 8 months on the east side, and CAR is 8 months. Now, why is the NPV 10 here is much higher than, let's say, for the west side? Well, I guess as you move forward, and I think we spoke a little bit about that. Maybe the composition of what's being produced is different, right? Maybe it's more kind of oily type of hydrocarbons being produced. Maybe here you have a little bit, different composition. But the other thing is that even if you have similar kind of hydrocarbons here being produced, maybe you have a different type curve where you're able to generate significant free cash flow over the course of kind of realizing that NPV over time, which gives you kind of this extra NPV 10 torque of $18 million. And again, you can see in IRRs in percent, much better economics on the CAR asset versus the west side, which is, again, highly economic. So anything over 100% IRRs is great. And yet you have 100 net locations here and 300 locations there. So that's really important to be mindful of that. So let's see what else we can share here. So obviously they disclose a lot of information. The Crescent Point is not kind of an easy company to understand because they have lots going on here. And you can see we can spend probably hours and hours talking about this. But let's kind of see kind of in summary what this company telling us that the advantage of Crescent Point, and conclude maybe this due diligence for what was done, and hopefully kind of added a lot of value for you guys to better understand how to understand this company. So operational excellence, premier operator with a strong track record of execution, innovative and highly technical team, unlocking value, extensive knowledge in secondary recovery, water floods. So that's basically what they're doing. They're very good at water flooding. Shareholder returns, returning 50% of discretionary excess cash flow in addition to base dividend. So they're basically telling us that they're returning 50%. But then again, they did this deal, right? And this deal really transformed the way their enterprise value is now basically partitioned, I would say, from debt to market cap level, because they did an amazing job trying to kind of reduce the debt. They saw this deal, they made this move, we saw how much production they've been adding. At the same time, they're saying, hey, we're going to be returning 50% of discretionary access cash flow in addition to base dividend. Targeting low to mid single digit growth, additional debt reduction. Again, they basically reduced all the debt. They proved themselves that they're able to do it. They've been reducing debt significantly in the last couple of years. Now they added some production, they added more reserves. They're like, hey, we're going back to our strategy to continue reducing the debt. And at the same time, they increase production. Differentiated portfolio. So industry-leading netbacks with 15 years of premium inventory. 75% oil and liquids production, strong market access, and low decline rate. So they're very proud of that 75% oil and liquids production. I think that number, based on 2022 review, just to be fair, was over 80%. And now it's under 80%, probably because of the deal, because you have that 55-45 partitioning between oleic phase and gaseous phase. But hey, they're very proud of the fact that they have this kind of higher liquid, I guess, production, and strong market access and low decline rate. So yeah, they're right. Although we're not talking specific type curves right now, but they did prove themselves that they have essentially no decline over the last couple of years. If you look at the overall kind of company oil production rates, or not oil and gas production rates, BOEs. Balance sheet and financial flexibility. Let's see what they say. Track record of significant debt reduction. They're right. I will not argue with that at all. The numbers suggest they're very good at paying down debt. They're very good. They've done this before. They added some debt here, it seems, to $3 billion, but I will never argue about this. Partially funded through dispositions, okay? So they made some dispositions, so interesting. And maybe that alludes to why their production dropped from like 142,000 barrels a day, I think, in Q2 last year, 2021. It dropped to like 120 something, I think. And maybe that kind of speaks to how they were able maybe to pay down debt faster, because maybe that money coming in. And obviously, I do a lot of due diligence on those companies, and I wouldn't necessarily remember exactly what deal that was, but I'm sure some of you know what's being discussed here. Target long-term leverage ratio of less than 1 times at low commodity price environment. Significant tax pools enhance excess cash flow. I really want to see what the tax pool is, so I will search for it right now. Disciplined team strategy centered around key pillars and balance sheet strength and sustainability. So good for you, Crescent Point. So thank you for that. Let's quickly search for a tax pool, if I'm able to quickly see what that is. Significant tax pool shelter excess cash flow in 5-year outlook. All right. Is there any more information? Let's see that number here. Cumulative ATAX excess cash flow. Yeah, I don't intuitively see what that number is right now, and it's time for me probably to finish the space anyway. So, okay, so stopping sharing. So we did, I had a poll on Twitter saying essentially, I did a MEG review in my previous video, and then I said yesterday, what Canadian E&P named due diligence video am I doing next? Name with the most likes goes next, and this is exactly what we've done today. So we have Duff with 39 likes here, so that's excellent. Congratulations, Duff. And I did due diligence on Crescent Point, so hopefully you guys are happy about what was done here. And this is recorded on YouTube. This is recorded now on Twitter Live. So hopefully it gives you a little bit of insight here to what Crescent Point is all about, the nature of this deal, what they're producing, what they're getting paid, the nature of their business, how they were able to kind of pay down debt over time, their sensitivity to oil prices. So I think we covered a lot of points here. We talked about what others are saying about this company, how it relatively performed to other assets. And so I hope you guys got a lot of value. One final thing is that this is not a recommendation. This is just due diligence to better understand this company. So please, talk to a financial advisor if you're going to make a decision. I don't own this name right now, but I'm doing due diligence, so maybe I will own it in the future. But I just wanted to thank everyone for your support. And again, if you want to support me, I have this book on Amazon. It's called Apollo Autism. Very proud of this book. It's one of those books that kind of, in my mind, I'll read it sometimes to just kind of go back, and it really makes me come out kind of more calm and, happy about life, more appreciative, and lots of learnings there also for investors, how to be better parents, how to be better human beings. So hopefully you guys got a lot of value from that. So thank you all so much. I will be doing more of those videos if you guys like those. Again, live on YouTube, live on Twitter. So thank you again. Hopefully you learned a lot about Crescent Point going forward and got a lot of value from this name. Thank you so much. Have a nice day.